So this is part 6 of dissecting the Nigerian Tax Act for clearer understanding. So remember, in the part 5 of this video, we brought to you the personal income tax comparison between the NTA and the PITA, and of course the non-resident company, that the scope of the activity that will be taxed and all of that, due date of filing personal employee returns, taxes, and the compliance requirements and all of that. So in this part 6 of this video, follow along with us. We'll be looking at the first part, the capital allowance. Capital allowance. So you can see from the screen, capital allowance. So capital allowance, right? We brought you a video on this separately on capital allowance. It is an allowance given in lieu of depreciation. So there is removal of the initial allowance on capital expenditure. What we have in this current tax we are using is that we have initial allowance and we have annual allowance. But NTA has removed initial allowance. And what is initial allowance? Initial allowance is an allowance that is given first the lifetime of that asset. It is given just once in the lifetime of that asset, but NTA has removed it. So we just have the annual allowance that will be removed on a yearly basis. So companies can no longer claim the allowance in the first year of putting the asset to use, leading to higher initial tax liabilities and reduced cash flow. That is what the implication is. This particularly impacts capital-intensive businesses, as tax relief on asset purchases will now be spread over time. However, the amendment in Section 27, subsection 4, which allows businesses with non-taxable income below 10% of total income to fully utilize their capital allowances, right, provide some relief. SMEs can now claim full capital allowances without proration, reducing taxable profits and CIT obligations, while capital-intensive businesses face delayed tax reliefs. This adjustment ensures that SMEs with minimal non-taxable income can minimize tax deductions on capital investments. So you can see what the implication of the NTA on capital allowance is for SMEs and other large companies. So qualifying capital expenditures and their rates. So 10% is what we have for this capital expenditure. Building expenditure, they have 10%, which is just annual allowance. Agricultural expenditure, mast expenditure, this for like telecommunication, the mast, you know what it is. Then intangible assets expenditure, heavy transportation expenditure, they are all 10% annual allowance. Then 20% is for plant expenditure, agricultural equipment expenditure, furniture and fitting expenditures, mining expenditure, other equipment expenditure is 20%. Then for 25%, we have motor vehicle expenditure, software expenditure, other capital expenditure, 25%. Then what we need to note here, unutilized capital allowance on the assets sold or transferred shall not be available for use in the new or surviving trade or businesses. That is what it is. Unabsorbed losses of the old business shall not be available for use in the new or surviving trade, business, profession, or vocation. So if a new a business that is operating before has now been merged or liquidated or absorbed by another company, you will not enjoy any transferred capital allowance. So it will just start afresh on the asset of the new company. The lessor slash hirer of an asset is not eligible to enjoy capital allowance on an asset. Capital allowance is to be enjoyed by the lessee. That's, you can see first schedule part 1 section 15 subsection 2 of the Act, where VAT or import duty was not collected on assets purchased, such asset will not be qualified for capital allowance expenditure. This can be seen in section 2P of NTA. So if you are buying an asset and you are meant to pay VAT on it, but you don't pay VAT on it, you will not enjoy capital allowance on it. So, and which will not be good enough. So every tax must be paid and accounted for. That is what it means. So we look at this illustration 2. Impact of the elimination of initial allowance on the cash flow of companies. What will be the impact of this elimination of initial allowance when we are computing for tax liabilities of company? A company acquired motor vehicle, equipment and furniture at 50 million, 100 million, and 25 million respectively. If the accessible profit of the company is 100 million, compute the capital allowance and company income tax of the company using the appropriate rates based on CIT, which has been repealed, and the NTA, which is now in force. So we want to look at the comparison of what we have currently and what we'll be using from 2026. So this is the answer solution. Computation of capital allowance and company income tax based on CITA, Company Income Tax Act, which has been repealed. So this is what we have. You can see it. You can see it. Let me make it more bold. Right? So you can see what it is. Based on the percentage, right? You can see what we have. The adjusted profits. You can see what we have. You can see what we have under CITA. So you can see the relief being granted, total profits that we have, then the tax rate of 30%. You can see what we have. That's 10 million. Tax liability is 10 million. So 10 million for CITA. Then, based on Nigerian Tax Act, look at what we have. Initial allowance has been abolished. So you can see what we are going to be having in the audited accounts. So you can see we have 10 million there and we have 18 million here. Look at the difference, it's wide. So that's difference of 8,750,000. And this is the action of the annual initial allowance being removed, which will no longer be available for tax deduction or allowance. So look how we have 18,750,000 as compared to 10 million under CITA. So company will be paying more if they are pulling more transactions for next year on 50 million and above. So asset loss or destroy, section 43 of NTA. What is the implication? Where an asset is lost or destroyed and the amount received as compensation is used to purchase a replacement asset within 3 years, any difference that results in a gain will be subject to tax. So you can see what it is. However, where the difference results in a loss, the difference will be considered a new asset for the purpose of computing capital allowance. So you can see the difference. Additionally, for the replaced asset, the capital allowance will be claimed on the portion that relates to the residual value of the replaced asset shall be limited to the tax written down value of the asset. That is what it is. Ascertainment of total profit of companies. How do we ascertain it? Total profit of a company would now include chargeable gains, while qualifying capital expenditure on which VAT has not been charged or import duties have not been paid will no longer be eligible for capital allowance claim. So if you are importing assets, make sure you pay VAT on it, import duty on it, so that you can enjoy your capital allowance and reduce your tax liability. Additionally, if a qualifying capital expenditure is used to generate both taxable and non-taxable income, the claim of capital allowances is still to be prorated accordingly. So it will still be prorated the way it is according to the NTA. So chargeable gains. With design of the capital gains tax to be income tax. Section 4 of NTA also progressively redesigned the capital gains tax regime by exempting some forms of capital gains from taxation, and in other cases, raising the gains threshold before imposing a capital gains tax. Example, the Act exempts an individual from paying tax on the proceeds of the sales of his residential property or land adjoining his residential property up to a distance of 1 acre. So if you have a residential property and it's sold, you are not meant to pay tax, you are exempted. So section, the Act exempt compensation paid to individual for personal injuries such as loss of employment, defamation, up to 50. This is up to 50 million, right? If you lost your employment and you are being compensated, you are exempted from tax. So we brought you this under the 50 exemption under NTA. Libel, slanders from capital gains tax once the amount is 50 million or below. Above 50 million, only the increased capital tax rate, the NTA increases the capital gains tax rate from 10% to 30%. So it's no longer 10%, it's now 30% on the gain, just like normal company tax computation. This effectively aligns the capital gain tax and company's income tax rates and reduces any tax arbitrage that could have been duly enjoyed in the classification between chargeable gains and trading income. For individuals, capital gains will be taxed at the applicable income tax rates based on the progressive tax band of the individual. We've told you this earlier on. There is tax exemption on compensation for loss of office, employment not exceeding 50 million. We've said this. Capital gain tax is exempted from sales of residential houses. We said this. Then chargeable gains and assets. The NTA chargeable assets include all types of property, including shares, options, rights, debts, digital assets, intangible property, and foreign currencies. So these are chargeable gains that will be subject to capital gain tax. 30% for companies and then for individual based on the personal income graduated tax rates. However, gains from selling shares in Nigerian companies are not taxable if you meet this condition. The Act exempts the sale of shares proceeds at less than 150 million, and the chargeable gain does not exceed 10 million within 12 consecutive months. That is the condition if you will be exempted from tax on the sales of your shares. The shares are transferred between approved parties in a regulated securities lending transactions. That's another condition. The proceeds from disposal are reinvested within the same employment, within the same assessment year in shares of Nigerian companies. However, the portion not reinvested will be taxed. So that is it. There's clarity there for you. So exemption on disposal of personal chattels. Based on section 52, subsection 1 of the Act, a gain accruing on a disposal of an asset which is tangible, movable property being personal chattels of an individual shall not be a chargeable gain if the total amount of value of the consideration of the disposal does not in a period of assessment exceed 5 million or 3 times of the annual national minimum wage, whichever is higher. So that is the conditions for you to be exempted from disposal of personal chattels for tax purpose. So we'll be stopping there in this part 6 of this video. So until we come your way in the part 7, please stay compliant. Please like, subscribe, follow us on this YouTube channel, and you can reach out to us to serve you, to work with your business support partner for all your compliances, tax, accounting, audit, implementation of your software, CAC services, any business compliance at all, SCOMU, VAT, whatever, just try and reach out to us. I'll be willing and ready to serve you. So bye for now.